Welcome to the session this afternoon. Thanks for taking the time to join us. It's great to see some of you filtering through. I'm just going to give it a couple more moments as I can see people are still coming through, but we'll look to be quite prompt and stick to schedule because we've got quite a bit to work through. I'll just give it a minute or so while I see people still filtering in before we start running through the slides. Just looking through, I can see there's a few names I recognize there. It's good to see you, Alex, Ava, Sid. Glad you're all able to join. Great to have you with us. We've had quite a few people sign up for this actually, so hoping for quite a good turnout. So really the purpose of today's session is, or I should say, first of all, most of you have been in touch with me at some point to discuss the program and discuss your interest in studying here at Oxford Said. So for the first kind of 5 minutes or so, I'll run through some information about the program and tell you a little bit more about the diploma and what studying here at the school could potentially look like. But the main focus of today's session is really a chance for you to get to hear from Tim Galpin, who is Senior Lecturer of Strategy and Innovation here at the Business School, and also the Academic Director for the diploma. So Tim will be talking to you today about mergers, acquisitions and joint ventures, which is one of his areas of expertise. I'll hand over to him shortly and let him introduce himself and tell you a bit more about today's session. But it's great to see so many of you with us. And yeah, we'll make a proper start now, I think. So the session today is, we want it to be interactive. So please feel free to use the Q&A, submit any questions. The chat function is up and running. So once Tim gets going through the material, please feel free to interact and ask anything you want to about the subject. But before we do that, I'm just going to provide a brief introduction about the diploma, because I think quite a few of you will have probably done some research about this already, but for those of you who are just really kind of exploring the program, this I think is a good opportunity for you to learn some kind of key details of the program and get a sense of what studying would be like. So just to start with the overall background for the diploma, this program is one of 5 diplomas here at the school. It's originally derived from our executive MBA, but it's now a standalone program with specialist content. It's a very established program. It's actually been running for a little over 10 years now. So we have a really strong community with this program in terms of the alumni network, the faculty, and it's just a program that's gone from strength to strength, which is why we now have two separate cohorts for this program running each year. The program is really designed for people who are executives and are looking to study something on a part-time basis. They'll be thinking about a program that they might be considering an executive MBA, but they might feel that program isn't quite what they're looking for. And this diploma can be a great alternative option for people who are looking for something with a really kind of academic focus, tight academic rigor, that looks at really kind of a handful of specialized subjects across the course of your time studying. And really people coming onto this program are often looking to underpin and build on the experience and knowledge they already have in the area of strategy and innovation, with real kind of formal academic knowledge and thinking about how they can complement their existing skills with the use of academic frameworks and concepts around the subjects. Plus, there's such a fantastic opportunity for you to network and learn with the diverse peer group that you're studying with. We see people from a whole host of different industry backgrounds and sectors within different functions in their organization. And it's an extremely global program. So it really is something that helps kind of set Oxford and these diplomas apart. Some key facts about the program. This diploma is taught on a part-time basis over 1 year. It's made up of 4 modules. So it works out that the study periods fall roughly every quarter. So you have 1 module that you attend, and then you continue to study towards that program across the year in between those modules. This is a master's level program. It's an accredited qualification, which means you're assessed during your time on the program. You're really held to account for what you study. And that takes place in the form of 3 examinations and then an extended assignment at the end of the program that's really designed to be related back to your organization, so it can have kind of an impact on something very close to you and your work. The program itself, we have 2 intakes running each year. It's our most popular diploma program. We anticipate next year that we'll have approximately 50 students in each class. And as I've touched on, they'll be from a whole host of different industry backgrounds and sectors. So it'll be a really rich and diverse class. And then importantly, from this diploma, upon completion, there is a pathway through to our executive MBA for anybody who's maybe interested in considering continuing their journey at Oxford and going on to the executive MBA. I won't go into too much detail here, but this just gives you a brief overview of the subjects and the main themes across the program that you study in each module. I did run a separate information session webinar a little earlier in the year that's publicly available on YouTube, and that goes into a lot more detail around the content of each module. So if you're keen to learn a bit more about that side of things, then I'd suggest visiting YouTube and having a look at that. It's a really useful resource. And finally, from me, for this first section of today's session, this slide is really just designed to map out kind of what your year at the school would look like, how the year would play out, kind of giving you a sense of kind of what the timelines are. And you can see some of the things I've mentioned here in terms of how the module structures work, when they fall, the content that you'll be studying in. But I think some important information that I haven't touched on are things like the study commitment in between the modules and what that would look like over the course of the year. This is a seriously academically rigorous program. So what that means is that you end up needing to put in around 6 to 8 hours per week of study time in between the modules. And that's it really in the form of preparation for exams and assessments towards the program. Understandably, there have been a lot of questions about the, excuse me. There have been a lot of questions about the delivery of the program. Oh, sorry, my voice is gone. I'll hand over to you if that's okay, Tim.
Want me to pick it up, Joe?
Yeah, if that's okay, sorry.
So, yeah, delivery of the program across the 4 modules. There's a question about a program allowing entry into EMBA or other master's courses. So, Joe, that one's more for you. Shall I get into my session, or are you back to finish up this slide?
Yeah, sorry, I think I can finish up now. My
Okay.
voice a little bit there. Yeah, so I was just saying in terms of the delivery program for 2022, we're basically working towards delivering in a hybrid form, hybrid between online and in person, which I think people will be able to see from the website. So we hope to have more people in person next year, but we'll still be offering online delivery for people who maybe are based in locations where they can't actually come and attend in person. Yeah, so that's it for me for the first part of the session. I'll hand over to you now, Tim, if you're happy to start running through your slides, and you can walk them through your content. That'd be great.
Do you want to handle the question that was submitted?
Yes, let me just have a quick look.
Okay.
So there's a pathway from this program to the executive MBA, but that is the only pathway that exists. So there aren't any other kind of direct links between programs other than those ones. The course fee would be, there's a question on the course fee as well. That would be the same, regardless of whether you attend in person or online.
All right, let me go ahead and dive into some of the content of this little example of our approach to lectures at Oxford on mergers, acquisitions, joint ventures, emerging markets, maximizing value. So as Joe mentioned, I'm a senior lecturer at the School in Strategy and Innovation. I am the academic director of the diploma program. So I actually, in between the formal modules that you saw on the slide that Joe just showed of the 4 formal modules throughout the year, I run 3 short deep dive sessions online in a plenary session, similar to what we're doing today, about various aspects of mergers and acquisitions. So I dive deep into M&A strategy, M&A integration, the human side of M&A, various aspects, both pre-deal and post-deal. So this is kind of going to be a fire hose overview of the M&A process and best practices. So if you have any questions, let's use the chat function. I'm monitoring the chat function, and there will be a couple times where I'll ask you to actually maybe put some input into the chat function, because I'm not just a straight lecturer. I like interaction, as all of our faculty do. So a big part of our program is not just us lecturing at you, it's also discussion, learning from peers. As Joe mentioned, we have amazingly diverse cohorts from all over the world, various functions, various industries, and people learn from each other as much as they learn from the faculty. So here's the 4 objectives I want to try to achieve over this next few little while with you. So first of all, what are the current M&A trends in emerging markets? What are key challenges of M&A across the entire process, not just pre-deal, but pre and post-deal? What does M&A success look like? We hear a lot of horror stories about M&As going wrong after the deal is closed. So I want to look at what actually works and how do we make them work, and what does success look like. And then finally, how do you manage M&A across process? Some of the best practices, again, a very high level overview. Some of you may have deep backgrounds in M&A, come out of banking, legal, consulting, corporate M&A, wherever it might be. Others view it may be a brand new topic, which is fine. So this is a little bit about me and why I'm at Oxford. I'm in my 5th year at the school. This is my 2nd career. I am not a career academic, so I got into M&A to bridge the divide between deal makers and those who make deals work. So there was, a lot of deals going on, obviously, for many years, led typically by investment banks, the legal advisory firms, but nobody was really doing M&A integrations and really looking at how to make deals work after they close. So a lot of pre-deal service providers, but not much going on after deal. So I do have a PhD from a million years ago at UCLA. From there, I started in corporate at Hughes Aircraft and Aerospace. Then I started business in London with a couple of guys, and we grew that business, sold it to Arthur Andersen many years ago. Lived in Germany for a year with them, liked living in Germany, didn't like Andersen. They blew up the firm with the Enron debacle, as we all know. Did strategy at Booz Allen for a couple of years, which is now part of PwC strategy. And then I became the head of global M&A services for Watson Wyatt Worldwide, which is now Willis Towers Watson. Had 90 offices, 30 countries. And my office was in an airplane and a hotel room, traveling around the world. Started my own firm again in 2001, sold that in 2005. So it freed me up to do this. It was a boutique M&A consulting firm, sold it to a group in Chicago. So now this is my retirement career. So the reason this is called Half-Life, there's an old book that talks about you spend the first half of your life trying to make money, second half trying to make a difference. And that's basically my career to a T. So that's a little bit about me. I've written 5 books. These are my 2 M&A books. The one with the blue banner on the right has been out for over 20 years, one of the best-selling books on M&A. And Winning at the Acquisition Game, the one with the gray cover, was just released this past year. So current trends in M&A. So COVID, first half of 2020, deals shut down basically to not happening at all. Second half of 2020, they picked right back up. A lot of deals were getting done remotely. So it's one of those things that now that we're coming out of COVID, at least in several of the countries around the world, through the vaccination programs, et cetera, deals are picking up again in 2021. So you can see the deal volumes in North America, Europe, Middle East, and Africa, and rest of the world. And on a geographic basis, this is from MergerStat, or I'm sorry, from Merger Market. There are various M&A databases out there. Some are free to access, open databases. Others, there's a subscription fee. So Merger Market, MergerStat, Deal Logic, and a few others. So this is from Merger Market. First quarter of 2021 is their latest data. And you can see the different deal volumes across. Bulk is in the US, this is 50+%, 25% plus in Europe. And then you can see what's happening in Africa, Latin America, and the 1.3% is in Asia. So the biggest sector, technology, actually a couple of years ago, it was mining and manufacturing. So it just shifts from year to year depending on what's happening in the global market. So when you're doing deals and you cross borders, especially into emerging markets, there are certain considerations that you want to take into account. And so let me ask you to start showing your expertise and typing into the chat. What are some of the key considerations you think of doing deals in emerging markets that makes them different from developed markets? So yes, Sid puts in, it looks like M&A trends are following vaccination rates. Absolutely. Value created absolutely is a different way of measuring value potentially. Some of the increase, here's a question from Haley of M&A, is attributed to the ability to build and grow new technology business very quickly and so more availability. No, not really. Deals come in waves, and there's been different waves for over 100 years now. They've tracked those. I don't have that slide in this deck, but there is a slide that I use in a more deep dive that shows that M&As go in waves based on several different factors. High stock price valuations, because stock is one of the currencies that companies will use to buy other companies. Low debt or low interest rates, so cheap money, so people can borrow to do deals and load up on cheap debt, and that fuels deals as well. Technology and innovation is another factor that feeds into it. So a lot of deals going on, especially post-COVID. There have been winners and losers in COVID, obviously, as we've seen around the world, different industries, even within industries, some in retail, obviously online retail, winners, brick and mortar retail, losers, and you're seeing winners buying losers. So those that have struggled are being bought by those that have excelled during COVID. A lot of deals going on in tech, a lot of deals going on in pharma, et cetera. Lack of reliable data, people are putting in about cross-border deals, level of infrastructure, geopolitics, politics, yes. So what we call non-market strategies, so the aspects outside of the market, like regulatory rules, political questions, capital controls, changing regulations, cultural differences, absolutely. So all good input. I don't see any questions. A lot of strength of rule of law, middle income trap, absolutely. So here's basically what you've typed into the chat. So thank you for that. Good participation. In class, you would be raising your hand, voicing your input verbally, whether you're online or in the room. So thanks for typing into chat in this session. Higher proportion of family and government-owned entities. So you find a lot of family-owned entities in emerging markets, which is a higher proportion than you would in the more developed markets. Partnerships and joint ventures are often required. So certain regulatory environments do not allow 100% foreign ownership. So you have to have local partnerships and joint ventures. Questions of government stability was put into the chat function. Financial and regulatory reporting transparency was put into the chat as well. And then this thing that I mentioned, non-market strategy, the importance of government influence review and connections. Many governments around the world are becoming much more protectionist, as we're seeing in the business news. And there was a big article in the FT just today about the regulatory environment in China with the foreign, scrutinizing foreign investment and acquisitions even more closely than they have in the past. So Zena's putting my company's interest in the kind of assignment topics that our other students have completed, or specifically in new business models, scaling digital products, proportions. you can do whatever assignment you want, and the final integrative assignment is basically a topic of your choice. So that is a final assignment after module 4 to Zena's question. And so you could do something on your own company, your own industry. Some people do the final integrative assignment on industries they're interested in maybe switching careers into. They're targeting a career switch. So it is your choice what you would like to do your assignment on. We have people from for-profit, not-for-profit, government, foundations, et cetera, startups, large companies, everything in between. So we get all kinds of different final integrative assignments, which integrate all of the information from the first 3, actually all 4 modules into that final assignment. So it's kind of a comprehensive assignment. All right. So that's some of the key considerations. Thank you for putting those in. So key challenges of M&A across the process. So M&A over the years has often been looked at as doing a deal. So, you identify that you want to grow through acquisition. That's part of your growth strategy as an organization. If you're private equity, obviously that is your strategy. You acquire companies, you sell them later on for more than what you bought them for. Hopefully, that's the business model of private equity. But everybody talked about M&A as doing deals. You identify target companies, you screen those companies, you settle on which ones you want to actually make a move on, either through a bidding process for companies up for auction, or as a sole bidder or negotiator with that one company. And then you negotiate that, you do your due diligence, do your valuation modeling. You either make a bid or negotiate a deal price, and the deal closes. All the legal and regulatory elements are taken care of prior to deal close or completion, depending on which side of the ocean you're on. And once that deal closes, that's when people said, okay, that's M&A. But that's only the beginning of M&A, where that's all where deal value is projected and agreed. Where deal value is realized is post-deal. So you see, this is a 3-stage model with 10 steps or 3 phases, 10 stages. I came out with this a number of years ago, and my first version of my M&A book had 6 stages, went up to 8. Now I'm up to 10. I think I'm done now. The 3 phases: you have your pre-deal, formulate your your acquisition strategy, locate target companies, investigations, your due diligence, financial due diligence, operational due diligence, technological due diligence, environmental, regulatory, et cetera. Doing the deal, you evaluate those companies. So you're doing your basic valuation modeling, precedent transactions, comparable businesses, your discounted cash flow and your LBO, and you're basically looking at a range. So valuation typically is not a single number, it's a range. Then you negotiate price, but you negotiate many other things as well. Consummating the deal, closing that deal, getting all the legal and regulatory filings taking place, your definitive purchase agreement is signed, money, in that signing, you will have that period between signing and closing often. And then once the deal closes, money changes hands, whether you're using shares, whether you're using cash or some combination. Then post-deal integration, the motivation of the workforces, innovation for revenue growth, and then evaluation of whether you actually achieved what you projected prior to deal close. And there are certain objectives across those different stages, as you can see here: pre-deal, deal, and post-deal. So here's a bit of survey results about it. Is difficult to achieve M&A success for acquirers. So if you want to make money in the deal world, you sell a company because companies will sell at a premium. An acquirer will not typically buy or be able to buy a company for what it's worth today. They're buying a company for what it's worth in the future, hence what's called the discounted cash flow of future cash flows. So Here's a bit of data from a couple different sources. Analysis of 2,500 deals found that more than 60% destroyed shareholder value for the acquirer. You can see the citations on the bottom. Joe will share the slides if anybody wants to dive deeper and look at these actual studies. You can see some of the other data here. The final bullet point, this is from my survey that I do for my book every few years. Almost half, 49%, say they're in need of merger repair. This is after they've closed a deal, and this can be 2, 3, 4 years in, and they haven't gotten the synergies that they projected. They haven't gotten the revenue increases they projected. They haven't gotten the cost synergy reduction they projected. And key customers have left, key executives have left, key employees have left, stock prices tanking. Several of my consulting assignments, I still am an active M&A consultant working with a company right now, actually, have been on merger repair, 2 or 3 years post-deal, trying to clean up what hasn't been working. So why does this occur? Why do these problems occur? There's challenges across the process. So this 10-stage, 3-phase process I just showed you, your deal strategy, targeting companies, valuation, negotiation, post-deal integration, et cetera. What challenges might you think occur across the deal? Whether you've done deals before or whether you haven't done deals, what might you speculate? What are some of the challenges, both pre and post deal? Again, let's use our chat function so we can type our responses in. What do you think might be challenges that you encounter pre and post deal? Differences in cultures? Absolutely. There's a great quote from one of the respondents to my last survey that I did for my most recent book. And it said, personalities overcame mathematics throughout the process. So we focus a ton of effort and money and in the investment banking fees that companies pay, all that sort of thing on valuation models and all the math that goes into, you know, the discounted cash flow, the LBO analysis, et cetera. And at the end of the day, personalities really outweigh mathematics when it comes right down to it. Deals are a relationship business, both pre and post deal. So yes, absolutely. Cultures, ego, big egos, yes, at the executive levels. There's a lot of ego in the M&A world. Earnout calculation method as the business will change focus. Absolutely. Earnouts are when some money is held back, pay a portion to the seller, but not the entire agreed sale price. And they earn out the rest of that sale price over a period of time after deal close for hitting certain revenue or profitability targets. That's all negotiated, included in the sale and purchase agreement. And those often end up in litigation afterwards. I actually do quite a bit of expert witness, and most of my expert witness work is on earnout disputes in litigation. Lack of trust, lack of information for proper valuation. Absolutely. As we know, those of us who've done valuation, it's all about assumptions. The 2 big factors that impact your discounted cash flow are your discount rate and, even more importantly, your terminal value. So these are terms that are foreign to some of you, but this is all about assumptions, and it's not an exact science. Valuation is not a science, often an art form. Internal software, yes, technology is big. Executive pressure, often to do a deal, even if it is costly and you're going to pay more than you should, absolutely. Intellectual property consideration, due diligence not done properly, especially when you cross borders, the due diligence gets more opaque. You have language differences, time zone differences, cultural differences. Again, back to the regulatory, the financial reporting differences, key staff leaving. Is it worth doing earnouts? G. Greg asks. Often I say no to my clients now because I've seen too many get into dispute resolution, litigation. I like when people keep the founders on to transition customers, industry knowledge, but at an arm's length as a consultant and not in an earnout situation. But they keep being used, they're super popular, and they keep ending up in dispute resolution. And litigation. So thank you for that. So all these challenges, here's some of the ones that you've already typed into chat. Sufficient and accurate pre-deal data for due diligence and valuation, et cetera, cross-border scope, cross-functional coordination. You have all kinds of functions involved in M&A. It's not just finance. It's not just tax or legal. It's also technology, marketing, human resources, tons of human resource and issues with pay, benefits, all of the compensation plans, et cetera. So all functions get involved across different companies. So you have a very complex, essentially project management issue to deal with across both companies or multiple companies if you're buying multiple companies doing what's called serial acquisitions. The biggest point here is the bold on the bottom. Small deal failure can be absorbed more easily. So doing smaller deals. I've worked on deals as small as $10 million for 4 people in a technology firm in Israel being bought by a firm in Silicon Valley to as much as over $40–50 billion deals, mega deals. I helped form our Seller Steel back when that was formed, which is now part of Tata. So I'm industry agnostic and geographically agnostic in the deals that I do, because I find that with the due diligence I do around planning for integration and then doing integration, there's a lot of transferable issues that pop up. So you're going to get a bit of theory at Oxford, not too much heavy into theory, but it is an academic institution. So here's a quick theory called bounded rationality by Herbert Simon, who was a Nobel Prize winner back in the 50s. Asymmetric information, basically 3 components to bounded rationality. Time constraints and cognitive limitations. So asymmetric information, sometimes too much, sometimes too little. And that is M&A. Sometimes you're going to have a lot of information, sometimes not enough at different stages throughout the deal. Time constraints. Often deals are under time pressure. Some deals drag out, other deals close very quickly, some deals within a couple of weeks. So time constraints, cognitive limitations. This is the big one where egos kick in. Everybody is the smartest person in the room, back to the old Enron comment and the name of their documentary, smartest guys in the room. Everyone thinks they're not going to make the mistakes that everybody else does. But based on the data we just saw, 2,500 deals and 60% destroying shareholder value for buyers, people are making mistakes, and a lot of mistakes. So it is a different activity than running a day-to-day business, and people get overwhelmed often with the complexity, especially around the cultural aspects. Again, those personalities that flare up, infighting that starts to occur, et cetera. So if deals are hard to make work after you close the deal as an acquirer, and if a lot of deals destroy shareholder value, and people know the stats, they read the same business information that we all do, Financial Times, Wall Street Journal. All you have to do is open it up every day or every week, and you see another deal running into trouble. Why do firms pursue M&A? Why is it such a popular strategy? You saw the deal volume stats. We're going to break records this year. Again, M&A is going waves. We're entering another wave coming out of COVID. Again, let's use the chat. Why do you think firms pursue M&A? Time, absolutely. It's a shortcut to growth. Access to customer databases. Buy is faster than build. Absolutely, Adam. It is. It's a shortcut to growth. If you don't want to spend the time building it, the organic growth that can take years, you just go and buy it. It seems like the easy route and the quick route. New capabilities, access to competitive technology, buying intellectual property, access to talent. Absolutely. There's things called acqui-hiring. Rather than hire 100 coders, you go and buy a company that has specialty coding capability in their talent pool that you need. You buy them, you get 100 overnight when you buy them. Accessing new markets, et cetera, expanding market share, taking out competition. That's under regulatory review right now in the technology industry in the US around the big tech firms go on buying sprees before companies reach the reporting threshold in the US, which is this year, I believe, 92 million. Then it has to be reported to the SEC. Below that, it doesn't have to be reported. So there's actually an article in the pharma industry called Killer Acquisitions, where pharma does the same thing, buying it before the reporting threshold and then shutting down potentially competitive drugs in the pipeline. So good, thanks for that. So here's ego. Yes, we're going to buy companies because we can. So these are all reasons companies buy. What you put in the chat, what you see here, the operational leap, that shortcut to growth. Targets are similarly, typically similar in industry products and services. Used to get a lot of cross-industry deals, not so much anymore. People typically buy within their own industry, although industries are converging. You're seeing auto manufacturers and tech doing acquisitions across industries, et cetera. And the prizes, channels, content, capabilities, a lot of what you put in there. Zena, go ahead and type your question in rather than a verbal, and I'll go ahead and try to answer that. Mandate, synergy identification, and successful execution. Again, you're only planning and agreeing value pre-deal, and at deal close, you have to gain that and achieve that value post-close through successful execution. And then the risk, eroding deal value through poor M&A approaches throughout the deal process. So what does success look like? We talked a lot about deals failing, destroying shareholder value, the struggles companies have when they buy other companies, especially as you cross borders. The complexity expands exponentially when you start doing cross-border deals. So here's a deal that was in the pump manufacturing industry, in the oil industry. They made big pumps for the oil industry. Global manufacturing company, $2 billion in sales. Did what's called a transformational deal, not just a small deal, but adding about half the size of the company. You see they had 75 million ongoing cost savings. They promised to their shareholders in Wall Street to achieve that in 18 months. Internally, they had a target of 106 million. So they're trying to under promise, over deliver. They figured if they even didn't make the 106 million internal target, if they made 90 million, they'd still exceed the 75 million they promised to Wall Street. They needed a clear integration methodology, project management approach, and a clear synergy measurement system. And here's what they achieved. So the black line was their projected integration timeline. The gray line was what was achieved in their service centers, their sales reorganization, various manufacturing locations around the world, USA, UK, South America, and Europe, and headquarters consolidation. This is the synergy targets. The 75 million is the blue line they promised to Wall Street. The red line, the 142%, is the 106 million they thought they could get internally, which were the projections. The green line is what we actually achieved with them through this solid integration planning and execution approach. We got them 131 million, or 174% of target, within 9 months, because it was planned well and executed well, and the cash flow accelerated. The CFO was very happy about this because it was a leveraged deal. They used debt to do this deal, and she could use the accelerated cash flow to help pay down that debt. And she ended up on the cover of CFO magazine a number of years ago in an article called Making Deals Flow. The company was called FlowServe. And that's what happened to their share price after the deal closed. So, or after acquisition announcement and deal close. All right, so that's what success looks like. So it can be done if you do it well, when you execute post-close. And how do you do this? How do you manage? So me issues pop up along the way. So again, let's use our chat for your interactive input. What do you think people worry about? So to this cultural and people thing that get in the way of successful integration planning, even not doing a deal, when deals are being negotiated. The Executives may not get along with each other. What are some of the me issues people worry about at the executive level, the middle management level, and the employee level? Their jobs and their future, job loss, absolutely. Thank you, Zena, Adam. Will I survive? 2 in a box. Yes, you have 2 of everything, 2 CEOs, 2 CFOs, 2 of the executive suite. You have 2 all the way down the organization often. Change in strategy, they worry about. What are their me issues? What about me? Changing culture, what are they going to be like to work for? Absolutely. Fear of the unknown, valuation of goodwill premium. Yeah, that's more of a valuation issue. Reorg, job security, future uncertainty. Absolutely. Okay, so here's the thing. Will I have a job? What my pay and benefits going to change? They don't have as good of benefits. We have better. Who will I report to? So the organization structure, my new role. Will I have to move locations? Their headquarters are across the country. That's one I'm dealing with right now. What will they be like to work for, this cultural thing? So it creates an inward focus away from customers, operations. People worry about this. They talk about it for multiple hours a day. This is a simple example. There is a productivity drop when deals are being communicated, whether through the grapevine or upon deal announcement. You have productivity on your vertical axis, time on the horizontal. Typical integration timeline is about 18 to 36 months. Senior management productivity drops first and comes back first, middle management second, employees third. Senior management are in the know. They know about the deal. They know what's happening. They typically know who's going to take what jobs at the senior level. So their productivity drops first, comes back later. Simple example in this. If you want to translate this into financials, let's say you're doing 1,000-person acquisition. The target has 1,000 people in it, management and employees. They are worrying about their me issues for an hour a day, talking about it, over Zoom in the hallways if they're in person these days. And what are they going to be like to work for? Are we going to lose our jobs? Pay and benefits change. You're losing 1,000 hours of productivity every day. They're not doing their customer service work, their operational work, whatever it might be. 5 days in a week, 5,000 hours in a week. You're 4 weeks in a month, you're losing 20,000 hours of productivity every month. The average integration period, even on the low end, 18 months, 360,000 hours of productivity just for people talking about their me issues for 1 hour a day. And as we know, those of us who've been through deals, they talk about it a lot longer than an hour a day until they get answers to their me issues. So if you look at the footer on this slide, management, senior management, really need to manage the integration and the communication around the acquisition from the employee's perspective, not their perspective. So a killer phrase from management, we don't need to tell them anything. We've announced the deal. They just need to get back to work until deal closes, and then we'll have more information. And often there's a very silent period where employees fill it with doom and gloom. A lot of assumptions are made, negative assumptions. People leave the organization, key talent, your best players, find a new team first. So management needs to look at it from the employee view, not their own view. So how do you do this successfully? Integration. This is a Deloitte survey of 2019 of 1,000 corporate and private equity executives that they surveyed and asked most important factor in achieving M&A success, integration. We spend a ton of time on targeting, on negotiating, on doing valuation modeling and deal close, and then integration is often an afterthought. So how do you do this? I'll run through these real quickly. I'm not going to read them all to you. Just in the green box, your clear M&A strategy is the objective. An unclear firm strategy leads to a poor M&A strategy. They do opportunistic deals. They don't go after targets that really fit their growth strategy and end up making mistakes in the strategy formulation stage. Locating targets that should fit your strategy. But if you're doing opportunistic M&A, you're going to target companies that are just available, and you buy them because you can, because they become available, and you try to fit them into your organization and they just don't fit. They should fit your strategy. Your investigation, your due diligence should be looking for everything to prevent surprises, financial information, operational due diligence, technology due diligence, human capital due diligence, only conducting traditional financial technology operations due diligence. That's good, but it's even better. You got to start looking at cultural comparisons, the talent you're buying, that sort of thing. That's often overlooked. Negotiate or evaluation. Using one valuation method, you should be using various valuation methods. You'll do what's called a football field analysis, looking for those overlaps across the valuation methods. So you're looking at a realistic range across those valuation methods. Negotiation, clearly defined deal terms as your objective. Poor negotiation preparation. You can get out negotiated, end up paying too much, end up not getting enough when as a seller for your company. Consummation, deal close, getting that purchase agreement. Again, buyer beware and seller beware of earnouts. They often end up in litigation. You got to manage that period between signing and closing, and maybe a few weeks, maybe several months, maybe even longer. That regulatory scrutiny that occurs. So not getting through regulatory, and you may have multiple jurisdictions you have to go through regulatory in. The integration, you want to accelerate your synergy capture, as we saw in the example I gave you. Delaying the start, dragging out the finish, not allocating the resources and the project management, program management attention that it needs. These are all big mistakes companies make in integration. This idea of motivation, the cultural aspects, communication aspects, the talent aspects of deals. You want maximum workforce productivity, but if you're only focusing on operational integration, you're leaving that, the human integration, to chance, and it does not typically go well. Innovation, you want your revenue growth out of innovation, cross-company innovation. If you only look at your cost synergy capture, you're going to lose sight of your revenue synergy capture, which is all about innovation. Much harder to capture, much harder to create, and much harder to measure. So a lot of companies only focus on the cost integration for those synergies. Evaluation, a lot of companies overlook this. They are on to the next deal. They say, well, yeah, that deal sort of worked. We're not quite sure. They don't do a postmortem and look back and say, did we achieve the cost synergies, the financial projections, the revenue synergies we were looking for? Did we get operations integrated in the way we thought we would? Did we get customers? Did we lose a lot of customers? Did we maintain our customers, et cetera, and do that evaluation and learn from one deal to apply it to the next. All right, there you go. Big fire hose, big high-level overview of M&A in a short period of time. Can't make M&A experts in a little 40-minute session, but at least you get a taste of M&A, maybe learned a few things you didn't know if you haven't done deals before. Tried to look at the entire process, both pre-deal and post-deal. We looked at what M&A successes looked like and how do you manage across the process. So if you have one key takeaway from this quick 40-minute overview session, what would it be? Let's use our chat. Thank you for being so interactive with the chat. Again, that's what we look for at Oxford. We want interactive discussions, learn from each other. What's your one key takeaway from this? Get the people part right, absolutely. Due diligence is key to success. Yes, for no surprises. Don't leap into M&A, absolutely. You have to think about post-deal. Thank you for that. Plan is always a good thing. Talent retention, yes, you don't want your key people leaving. Capturing synergies, clear strategy. Yes, strategy is key. Defining measures of success, absolutely. All right, good. So thank you for your input. Thank you for your participation, albeit through the chat function. Again, during class sessions, you'll be asked to raise your hand, open your mouth, make verbal comments, all those good things, learn from each other. And that's a interactive learning environment that we try to facilitate in all of our modules. So I look forward to seeing you in the program. Thanks for taking the time today for this little example lecture. I'm going to stop sharing and I'll turn it back over to Joe So if there's any program questions, we can answer those.
Yeah, great. Thanks, Tim. That was super interesting and hopefully gives people a good little taste and example of what you could expect from the sessions here at Oxford. And thanks for being such an interactive group with the chat. Great to see so many questions and so much input coming in. So briefly, just to flip the focus back to the program, to give you an idea for those of you who are considering applying, if you haven't already, the next steps and what you'd need to do. In terms of admission requirements, briefly, we look for candidates to have a good degree and at least 5 years relevant experience for the program, but most people do tend to be quite a bit more experienced than that. In terms of requirements, we don't require a GMAT, which is something people often ask. In terms of moving forward with an application, there are a few things you'd need to start working on, namely putting together an up-to-date CV, compiling your degree transcripts if you don't already have those, thinking about 2 people you'd like to nominate as referees who'll be able to give you recommendations for the program. And then finally, there are a couple of essays as well that are involved with the application. One really focused around your motivations for studying this program and what you might hope to gain, and the other about your current role in your organization and what you would say your main achievements have been. So those are the main things to start thinking about. When to apply. So there are a few application deadlines coming up soon. We've had 2 that have passed. The next one is quite a big one because we have a couple of scholarships linked to that. As you can see here, it's the 18th of October. You'd need to apply by then to be considered for the second round of our directors scholarships and also our scholarships for women. Candidates who meet the criteria of both are welcome to apply for both. And we aim to give a decision to you probably early in, I would say early November. So be mindful of those deadlines because they are coming up quite soon, and the same deadlines apply for both cohorts of the program, whether you choose to apply for January or March.
Joe, there's a couple questions that came in.
Yeah, cool. Let me just have a quick look on the chat.
So the 5+ years experience, is that a must?
It is, yeah. So we try to be holistic when we're looking at candidates, but we do feel that people need to be at the right kind of level to be able to fit into the program, to be able to contribute based on their professional experience. So that is a hard cutoff for the minimum experience level. And as I say, people actually do tend to have more experience than that. The average level is almost always around 15 or 16 years on the program. So yeah, that is a hard rule.
Paul is asking CV ?
Yeah, so you would need to, as part of the application, just provide an up-to-date copy of your CV. There is no strict format or template for that, but you just need to upload that as part of the application.
Sid asks, when are the directors' awards announced?
So we've just had one deadline at the beginning of September. The candidates for that are due to be reviewed very shortly, so they should receive a decision within the next few weeks. In relation to the second round, the October deadline, the 18th, the decision for that will probably be, I would say, early to mid-November, when candidates will be informed of the decisions there.
Benjamin's asking 2 questions. How's the content spread between strategy and innovation, 50-50? That's hard to answer, Benjamin. That's really me as the academic director. The first module is all about strategy. I actually teach that module. So, and then your second and third modules are all about innovation. Fourth module is about strategy execution. So it is about 50-50, I suppose, when you take a look at it from that perspective. Although in the strategy module, we do talk about innovation because you can't talk about strategy without talking about innovation. So that's why I said it's sort of hard to answer that one. Your second question, is this viewed as a prerequisite for an MBA or equally complementary? It's not really a prerequisite for an MBA. It's, a specialty area that people want to dive deeper into. So they would take the strategy and innovation or diploma in financial strategy, whatever it might be.
Yeah.
Hopefully, Benjamin, I answered, or I'm sorry, yeah, answered both of those.
Yeah.
Zena, my company's interested in sponsoring is be keen to understand, speak to someone, specific research assignment required. That again is your choice, Zena. After module 4, your final integrative assignment, you can do it about your company using company data and information. And we are all under NDA. So if you submit any kind of proprietary information, we do not share any of your assignments with anyone or any information. Yes, you can have the presentation of today's session. Take us, Joe, I assume you're going to be able to send that out.
Yeah, we should be able to do that, or reach out to me individually if you'd like a copy of it, and I'll happily send that across to you. That's absolutely fine.
Zena is asking if the diploma isn't right, they might be interested in paying for collaborating on research. Zena, send me an email. You can look up my profile and then just send me an email and I'll point you in the right direction if that is something that your company wants to pursue.
Yeah.
Criteria for scholarship, Joe?
Yeah, so the criteria similar in some respects across both scholarships. They'll consider academics, professional achievements to date, but then they differ slightly. So the women's scholarship is thinking about how you'd be a good role model and how you'd work with us to help promote female candidates joining the program in the future. And then both also consider the impact that the scholarship would have on you and your organization and what you might be able to give back to your industry, as an example. The full criteria are available on the website. So if you go to the main diploma page and look at scholarships, there's a link to both, and it gives you details there of what you need to include.
Yeah, Haley asks typical participant journeys in their careers after the course. Some participants change careers from industry to a new industry. Others use this as a way to get more enriched in a particular topic like strategy and innovation, to accelerate within their own career path within their current company. And so there is really no typical career journey, but we have had participants that have switched, either companies or industries. Others stay within their own career path. How you split between online and in-person will work. It's a hybrid format, so some people during a module will be in the room. Now that UK travel regulations are being relaxed, we are having more and more people in the room, and simultaneously we have people online. We have the technology in the room set up for people online to be logged in via Zoom, hear everybody speaking in the room. They can also speak and we hear them in the room over the loudspeakers. We can see people up on the screen. So it's a fully technologically hybrid format that we learned a lot about over this last year and have upgraded our tech on that. Are there lectures, presentation outside the in-person modules, or is it just reading? Yeah, Sid, I mentioned I do a deep dive, 3 90-minute sessions in between modules 1 and 2, 2 and 3, and 3 and 4 on M&A and a more deep dive into the topics that I covered today. Drop your email here, Joe. Joe, you want to type your email into?
Yeah, I've just put that in there.
I
can see what the typical cohort size is. So for next year, we're predicting it will be around 50 students in each cohort in that kind of region.
Yeah.
So that's what
the cohorts are awesome. 50 is a good size. It's not too many. It's not too small. A lot of great diversity, a lot of great networking you get out of it. We've had people in our cohorts who are CEOs of companies, started their own companies. We have them from all industries. We have an executive vice president, so one of the top 10 people who's just retiring. Actually this month from Microsoft is in this year's cohort. All kinds of different people in our, in different stages of their careers. But again, average about 15 years of work experience. So.
Yeah, absolutely. And that's really one of the things that creates such an interesting dynamic in the cohorts, the debate and discussion that goes on, people often bringing very different perspectives,
right.
types of backgrounds. So yeah, we love welcoming students, and I know Tim and all the faculty love teaching on the program.
Absolutely.
Perfect. Well, I can see that we've come up to the hour mark, and I can't see any more questions that have come in the last minute or so. So if anyone thinks of anything else, feel free to get in touch with me if it's program related, or Tim, if you have any particular questions about today's session. The next step now is just for you to all apply. We hope to see you on the program. We'd love to see an application from you all. And yeah, thank you, Tim, for taking the time. And I know you have a very busy schedule, so it's been great to hear from you. I know everyone's really appreciated it. So thank you.
Thanks everyone for attending.
Perfect. Thank you, everybody. All the best.